started. Again, my name is Bernard. I'm with Insurance Advisors Direct, and this is our weekly Wednesday annuity series. And we have a special guest with us, but I'm going to let Brandon introduce the young lady here. So this one is kind of special. So, we have a lot of Medicare agents, and we have a lot of agents that sell long-term care. But now we're going to find out, well, how you can use annuity money to pay for long-term care expenses. So I'm going to turn this on over to Brandon, and then Brandon's going to introduce our special guest. So Brandon, my friend here, take it away.
Yeah, thanks, Bernard. Thanks to everyone for joining us. I know this is a really busy time for you, so we certainly appreciate you taking some of your day to spend it with us. And I am really excited for a couple reasons to bring this to you today. One, if you've been on these sessions, you know I usually spend most of the time talking. And so I'm excited to give you guys a break from listening to me. So I will not be the speaker here. I am actually going to hand it off to Melva Newbro. And what she's going to cover is actually something that I think is really, really pertinent and really, really important for you folks to know. We've been talking a ton about annuities, retirement income. How does that tie into what your clients are looking for right now? And we've spent a lot of time on that. But what we're bringing to the table today that Melva has with North American is a really special product. It's actually the only one that I know of off the top of my head that works like this. And so what it does, and I'm not going to step on Melva's toes, I'm going to let her go through it all. But essentially, this product allows your client to access benefit bonus to their cash value for long-term care and healthcare needs. So if you have a client that has Medicare but not long-term care, or doesn't qualify for long-term care but they want some level of protection, this product can do it. And it does it in a really special way. Most of the products you're going to see are going to say, you have to have an ADL qualifier and you have to be in a qualified care facility. That's a big problem these days because many folks, as we talked about in our retirement roadblocks, don't necessarily want to go into a facility. They want to stay home, and that's becoming more and more the case as people live longer and longer. This product lets them stay home, which is really unique in this space. Honestly, I look to this product whenever I have someone that's looking for a way to supplement their long-term care, their Medicare, or they don't qualify, but they want to stay at home and they want to be in control. And this is the one to do it. So Melva's our internal partner here with North American. And what I'm going to do is I'm going to step back. Melva, you're the expert. I know you know this stuff inside and out. So it's all to you. Take it away. And thank you again for being with us.
Awesome. Oh, thank you for that great introduction. Hey, welcome everyone. I'm super, super excited to be here and to take just a little bit of your time. And I'll be real respectful because like Brandon said, I know this is such a busy time and I appreciate what you guys do so much.
Hey, there it is. So Jesse already asked a question and I forgot to mention, send in your questions using the Q&A and the chat feature. At the end of this, we'll be able to ask Melva as well. So Jesse, thank you right off the bat for your question, and we'll bring it all around at the end. So I forgot to mention that, but back to you, Melva.
Oh, thank goodness. Okay. Gotta love technology, right? Here I am. Yay. Okay. So let's get started. So our unique product here is called the Versa Choice. And it is a fixed indexed annuity. And I know that you've been kind of looking at doing some things with annuity sales. This is just to give you just a general background of the product. Here we go. It is a modified single premium. Clients can add money just until the 1-year anniversary. Simple 10-year surrender charge schedule. You get to take out 10% penalty-free withdrawals. We write it all the way up through age 79, so it can still issue as long as the client has not yet turned age 80, and the minimum premium is $20,000. So very basic information. state availability, this is pretty cool. We only have 2 state limitations within this product. Number one, we don't have any products available for the state of New York residents. Even if they go to an outside state, you can't write it with North American. Just that Reg 60 messes those poor New York clients up. The other state variation, there is no 2-year point-to-point in the state of New Hampshire as far as your allocations go. But you know what? The Enhanced Liquidity Benefit Rider, also known as the ELB Rider, which is the exciting part that I'm going to share with you about this product, is approved in every single state, and there is no state variation. So even with this ADL benefit, California, if you're listening, you have this benefit as well because it is not a multiplier, it is a liquidity rider. So that is fantastic. So just a little bit about, we've got this product is geared to be an accumulation product for your clients. And I know that's not the main meat and potatoes of what we're talking about today, but it is a fact that this is an awesome product as far as the crediting goes. It has a great potential for your clients to earn some nice credited interest rate without any of that downside, with the downside protection, how I should say. So in 2020, this is an actual statistic, the fixed indexed annuity owners averaged 6.7% interest credit in the year 2020, and those are actual figures. So again, along with this wonderful liquidity that we're going to be getting into, this is a good accumulation play for those clients. All righty, here we go. So with our Enhanced Liquidity Benefit Rider, so the fee for this rider is 60 basis points. So with that 60 basis points, your clients are going to get 4 benefits. 4 benefits. So we're going to go through the first 2, and then we're going to go through the really exciting 2. So they are going to qualify for some enhanced penalty-free withdrawals. So there's lots of nice liquidity features built into this product. The 10% penalty-free is available in the first contract year for the client. If they don't take a withdrawal in that prior year, then their penalty-free amount rolls up to 20% of the value. So does it go up from there? No, it's going to stay at 20% until they take a withdrawal. And then again, if they don't take a withdrawal in the prior year, they get to take out 20% the following year. So essentially, they could really take out 20% every other year of their beginning of year value. So that's pretty nice liquidity on that. Also, you got to have some clients that are like, you know what, I got to have some peace of mind here. What if I get into this and I need out, or it's just not performing like I thought it was going to? There's a return of premium feature that's built into this liquidity benefit that says, client, day 1 of year 3, if you want out of this contract, we're going to return your premium to you, surrender charge free. So a nice peace of mind for that client to be able to get back their money if they're not satisfied with the product. Again, they do have to wait till year 3, but that's not a pretty nice time frame to be able to do that. Then we get into our nice activities of daily living based surrender charge waivers. So this is the exciting meat and potatoes part for you Medicare producers out there that you, like Brendan said, if you've got clients that don't qualify for a long-term care policy, or they just simply don't want to pay for that long-term care policy, this is a super great alternative. And this is really where I see the enhanced liquidity benefit being used on the VersaChoice product. So the first thing you see there is we do have this ADL-based surrender charge waiver. What does that mean? Simply means that on a disclosure, when you write this policy, if that client can say, yes, today, when I sign this document, I can perform all 6 activities of daily living. They qualify for the product, they can qualify for that ELB rider. Anytime after that issues, if we get a letter from the physician stating that the client cannot perform 2 of 6 activities of daily living and that they're expected to remain in that state, their policy becomes 100% liquid. That is anytime after the issue date. So it doesn't have to go through a year of waiting. It's not nursing home confinement bound. It is just simply the letter from the physician that generates that liquidity for that client. If the client needs premium out, they don't need to do any type of receipt reimbursement. It's whatever they need that premium for. If they only need, say they have a $50,000 policy and they just need $10,000, they can come in and grab that out. We're not asking them what they're using that for. They can use that for whatever they wish. So then we have this great ADL payout benefit. So let's say they're going along and we come into year number 4 of the contract, beginning of year 4, and they qualify for their ADL-based liquidity. They have, again, the option, it's 100% liquid to them to take out whatever they wish, but they also then have this opportunity to multiply their value. So in year 4, we're going to take 115% of whatever their accumulation value is, and that gets paid out over 5 equal payments, 5 annual payments. So it's just like starting really a 5-year SPIA. If it's non-qualified money, we do the cost basis, so they're not getting taxed on their whole gain first, which is quite the benefit as well. And someone will get those 5 payments regardless of whether that's the client or their beneficiary. We get asked that quite a bit. And you can see that that multiplier does continue to go up. It does begin day 1 of year 3 of the contract with 110%, and it goes all the way up through year 6 and above. You would get 125% of the value. So this is really why we use this as a long-term care alternative. You know, if your client qualifies for long-term care and they're looking to pay for long-term care, then that's great. But you know what? If they don't, then this is an awesome alternative in an annuity product that can also give them some nice growth potential. So I believe this next slide here is going to show you the benefit of that payout, that enhanced payout benefit. So year 4 of this contract was worth $169,000. Because of the multiplier factor, we're going to add an additional $38,900 to that. So they're going to get a payout of $194,615 over 5 equal payments. And you can see as if they wait till, say, year 10, how that's going to continue going up. So nice there. So in summary, so your state variations, even California, I always mention them because you know, none of our multipliers are available in California. It's such a sad state for their clients. But this one, they do qualify for that liquidity as well. So no state variations with that enhanced liquidity benefit rider. Again, it's 60 basis points, so a nice low fee for the client. We have a published accumulation play, so with a first-to-market liquidity that you can offer. And then bridging the gap with solutions you create with costs not covered, basically just that, again, means you don't have to show us receipts for us to pay out to the client. If they qualify for the ADL-based rider, then their policy is liquid to them. I have just at the end of this, we got to go through all the wonderful disclosures, don't you know? Okay, so we have 2 flyers that are consumer approved for you to utilize with your clients. One is just giving them the layout of these 4 benefits within this enhanced liquidity rider so that they can see that. To get further information, contact your professional, very much a client approved piece. And then the other one that we do also offer for client approval is just looking at your activities of daily living and defining those for the client. So that's really the nuts and bolts of that enhanced liquidity benefit rider with that, you know, the ADL-based liquidity. It is good for home health. It's just a really nice, and like you said, a first to market. I don't know of anyone else that offers something like this. So hopefully you can find some benefit and use for that within your client base and on your sales. think that'll do it for me.
All right. Well, Melvin, actually, we have a couple of questions.
You know, all 4 of these benefits, again, are available with the 160 basis point charge. So that's a big important thing to remember, because even if you don't think that the enhanced penalty-free withdrawals are going to be something that your clients are going to want, it's still available to them if they get the rider benefit, because they have access to all 4 of these benefits. So enhanced penalty-free was rolling up from a 10% penalty-free withdrawal up to a 20% penalty-free withdrawal. And that's available if you did not take a withdrawal from the policy in a prior year. Return of premium kicks in day 1 of year 3 of the contract, where the client can get their premium back out, surrender charge free. Now, I do have some that ask, well, what happens if I've had a lot of gains and it's, say, year 4 of the contract? Really, I liken return of premium to doing a surrender request of the policy. So you send us a surrender request. We're going to look to see if you have this enhanced liquidity benefit rider, what is higher for your client? Is it getting their premium back out, surrender charge free, or is it actually the surrender value of the contract? Because you do have some opportunities to earn some nice growth potential. So it could be a case where your surrender value may be higher than just getting your premium back. So look at it that way, but at least the client does get their premium back out. ADL-based surrender charge waiver, again, simply means it's 100% liquid. As soon as you qualify, and qualification is the letter from the physician stating that the client cannot perform 2 out of 6 activities of daily living and that they're anticipated to remain in that state. It becomes 100% liquid at that point. And then if you did want to utilize the ADL-based payout benefit, that kicks in day 1 of year 3, where you can multiply your account value by 110%. Year 4 would be 115, year 5, 120, and year 6 and above, 125%. So that's a multiplier times your account value at that time, and then it gets paid out over 5 equal annual payments to someone, whether that's the client or their beneficiary.
Another question, is there a rider fee?
The rider fee is 60 basis points, so 0.60%.
Okay. And then to Cheryl, she's asking what license do we need? Well, this is a life insurance product, so you'll need your life license, and then there's other little certifications that we have to, suitability tests we have to take.
There'll be some product training, which is,
yeah.
See, I've already trained you on the product, so it'll be like a piece of cake for you to go through.
Right. So, yep, Jesse, your life insurance license is what you will need. And here, what else? We have a few other questions for you. Will it continue to grow after 6 years?
Oh, the multiplier does not. It stays at 125% after the 6th contract year and above. So, you know, if you're in year 8, it's still 125% times your account value. But your accumulation value absolutely continues to grow during that whole period of time.
And other question, if I use IRA for 401k money to pay for the premium, will the payout be tax-free?
Unfortunately, it is not. No, because this is an annuity contract, it is going to be fully taxable on IRA qualified money.
And Jesse, yes, there is suitability training. Each state has its own suitability, and you have to take the suitability training, and then each annuity carrier has its own compliance testing course for each product.
And don't let that freak you out. It's pretty easy.
That's right. I see no other questions here. Let's see. Will the annuity plan also cover a long-term care facility?
Yeah, it's really truly based on that activities of daily living. And if that client, no matter where they are, whether they're home-based or whether they are in a facility, as long as they can't perform the 2 out of 6 activities of daily living, it is covered.
All right, folks, are there any other questions for Melba? Don't see any. Well, Melva, I thank you. And I mean, this is, got one more. So I have a client who is taking medication for bipolar and it has denied him long-term care plans. Can he get this?
You know, again, at the time of application, we do ask that client the question on the disclosure, can you perform all 6 activities of daily living? And that's really, there's no other underwriting to it. If they answer that question, yes, I can perform all 6 activities of daily living as of the date I'm signing this, then yes, they qualify for this enhanced liquidity rider.
Yeah. So I'll say this, I'm actually working on a long-term care illustration for one of our agents. And the husband, he's 67 years old, but he's insulin dependent. And for the particular carrier, we have to fill out a call it diabetic form. So I'm asking the agent, well, does this person have any assets that we can use? We can put it into an annuity because I know he's not going to qualify for a traditional long-term care because he's insulin dependent. And as you get older, you know, in life insurance, you get older and you're insulin dependent, you have a kidney failure or anything, and you have a greater chance. So those carriers are going to deem that as uninsurable because they don't want to take on that risk. So yes, this policy would be, if they have those assets, this annuity product would be perfect. So, yes, ma'am.
Good.
All right. Brandon, you have anything, my friend?
You know, first off, Melva, thank you. Really excited. Again, I think some of the big highlights of this where really stands out is for folks that don't qualify or can't afford or don't even want to pay for long-term care. As you continue to look at that industry, the number of carriers and the number of products is just narrowing down because there was a big kind of swing and a miss on the estimation of how much this would actually cost folks. And you're seeing, you know, rates increase. You're seeing the underwriting become more stringent. This is a great alternative where you don't have to go through underwriting. You don't have to answer anything more than can you do the 680Ls. Really great opportunity. And this still has all the features of a standard FIA where you can't lose money. That accumulation grows. And when you do turn it on, again, you get whatever percent bonus to your account value. Now, I think, you know, you hope you never turn it on because that's, you know, insurance, right? You don't want to have to use it, but it's there. And in the case of a product like this, if the client doesn't touch it, they can go ahead and pass it on to their heirs, their beneficiaries, not like a long-term care where the premium is gone. As this case, you can pass it on. And yes, back around the question, Jesse, for earnings are never negative. Never. In this case, you want to think zero is your hero. If the market goes down, your client gets a 0 return. If the market goes up, they get a percentage of that earnings based on how they choose to have the investment placed. So essentially, no possible loss. So like an IUL, I think it's similar. I don't know a ton about that. Bernard, you know the IUL world. Would you say it's just pretty similar to that?
Same concept. And actually the IULs came from the fixed indexed annuities. So they put that component and so exact same thing. Only thing with the IUL, you're going to have to go through underwriting because it's an actual insurance product. So,
Right.
yes.
Thank you. And the last thing I'll say again is, as you look for products like this, when you've got clients that are looking at it, the only place you're going to find really these types of products are going to be in that insurance carrier space. Again, I've worked with a lot of carriers, I've worked with a lot of products, and I haven't seen one that's as simple as the VersaChoice 10, where you are able to use it at home if you want. Again, that freedom is a big selling point here. So I guess what I will say is, if this triggered a, what's the difference for this one over others? Well, Cheryl, I'll give you a couple things. One is they have what's called the enhanced liquidity benefit. Now, some annuities have these types of, they might call them an income doubler. They might call them, an enhanced benefit. That feature is not necessarily unique just to this product. What makes this one unique is the fact that it's only 2 out of 6 ADLs. Many times you'll see 3 or more. And what I've seen almost every time is it says you get this for use in a qualifying facility. That's not the case here. You use it the way you want to use it. And I think that right there, that phrase makes this product so unique, where you do not have to go into a home or a facility to use it. You use it as long as you hit those qualifiers the way that you want. And if you never use it, the money is still there to either be used as income or to be used as a benefit for your beneficiaries, heirs, and whatever your legacy your client would want. Which I think, again, it's not use it or lose it. It's use it or give it away. Totally up to them. So again, what I would say is, if this caused a curiosity, a question, hey, that's unique, I want to know more, your great place to go is going to be to Bernard. He can get you the info, get you set up. Melva, we got another question that came through. Can they stop the payments if they want?
After they have initiated, if they have actually utilized the multiplier benefit and started those 5 equal annual payments, those are locked in. It is very similar to an immediate annuity, where they're just simply, then we've structured it. We're giving out exactly this much to the client for 5 annual payments. So those cannot be stopped. So, but if they haven't started that, then they can come in again at any point in time, because the policy is just simply liquid to that.
Excellent, thank you.
Some weird lighting.
Again, if this caused a question, if this caused something, Bernard, reach out to Bernard. Bernard has a direct line to Melva. He has a direct line to contracting, case analysis. He is able to get you that information. And we're still going. We're going to keep flying. This is live. Melva, did you see that one come through?
Yeah.
All yours.
So if, let's see, it was if the person dies in year 3. So if the person passes, this is a really nice thing too, and I didn't touch on this, but Brandon, thank goodness, you did bring up the fact that it has a death benefit. So the accumulation value is available to, you're talking about the payout. Okay, I'm going to do 2 things here, just super quick. So if they are in the 5 annual payout and they pass, they have a named beneficiary who will continue to get those payments. So it's not the company that's going to keep those 5 annual payments. If the client's taken 3 and they pass away, then their named beneficiary is going to get the remaining 2. So someone gets those 5 payments, not the company. I'm going to go back to just a regular death claim. So the death happens, say year 3, the client passes away. So our normal annuity is the fact that the beneficiary can take that accumulation value, what that's grown to, and they can take that out as a lump sum, or they have different payout benefits under a death claim. You know, okay, it is an annuity, so non-qualified is going to be taxed on just the gain. Qualified is going to be taxable to the client. But if, let's say that client has a spouse who is the sole primary beneficiary, and they have this enhanced liquidity benefit rider, and I'm going to remember to put this in my next PowerPoint, because if that client passes away, that spouse can step into this contract and they can continue both the accumulation value and that enhanced liquidity rider. It passes on to their spouse. So great question.
Awesome. News to me as well.
Yeah.
I didn't know that feature
Yeah.
that
Didn't
you
know
could
that?
pass
Yeah.
it on and cover both, which again, that's a huge benefit.
In a spousal situation, yes. No, it cannot pass on to a child, unfortunately. A child beneficiary is just going to have the opportunity to do the death claim and get the accumulation value out. Good question.
Awesome.
Okay.
Again, guys, thanks for these questions. Keep them coming. I'm going to ramble for maybe a minute more. So if you have any, last shot. Otherwise, Bernard is your direct line to Melva for contracting case. Anything you would need, he can get you set up. And again, we can help you out wherever it goes. So what I will say is thank you for joining us. A huge thank you to Melva. I think this was huge, by far and away the most engagement I think we've had on a webinar. So I hope that leads just to some new ideas, some new approaches, and some more questions as we go. So thank you so much, Melva. Bernard, I'll let you close us.
All right. Well, okay, Jesse.
That doesn't matter,
okay.
Jesse. You asked great
That's
questions.
perfect.
Yeah.
I'm sure other people were thinking it.
But just a quick tip. October, of course, is going to be the beginning of Medicare AEP, October 15th. But the beginning of October is the biggest season for CD renewals. So all you folks, before you start writing those Medicare Advantage plans, reach out to your clients now before October 15th and see if they have those CDs in place, or 50, 60, 70, whatever the case. And this product here, Versa Choice, or actually any other product, but the Versa Choice would be an excellent deal for them if they're looking for long-term care insurance. So it's twofold. Look at them, your CD clients, because I'm pretty sure your Medicare clients have CDs. So look at those folks, review their Medicare Advantage plans, and then October 15th, write the annuity first, and then October 15th, you can do a new enrollment if that is needed. So this is a little quick tip. And folks, if there's nothing else, Melva, again, thank you. Brandon, as always, my friend, thank you. And I'm going to reach out to everyone that's been on this call, send you contract and ask if you have any questions, and we will go from there. And like Brandon said, we are here for you. We will do everything to support you. We just can't get on the call with you if you're on with your client, but we can do everything else. If you need a one-on-one to help with your presentation, we can definitely help you out with that. So, Jesse, yes, we will definitely, got your email address, definitely email you some literature on the Versa Choice product and anything else that you may want. So, all right, so that makes it 100% now, Jesse, so.
Oh, you guys are
But no,
awesome.
thank you. Everybody, thanking you guys. Have
Thank
a great
you.
rest of your week and a great weekend. Yep, you win.
Thanks very much, everyone.
Take
Appreciate
care.
you having me on. Thank
All
you.
right. Bye.